Welcome back to the deep dive. Today we are tackling something pretty complex. We've got this whole stack of documents, 32 critical questions, legal notes, even a full action plan.
That's right. And it all centers on a major governance breakdown in a large homeowners association, VVR way.
Right, VVR way. And we're digging into it because, honestly, it looks like a textbook case of, well, things going seriously wrong.
It really is more than just, local issues. It touches on fiduciary failure, asset misappropriation. We're talking crores of homeowner funds potentially mishandled.
The sources themselves point to this system of opacity, a lack of transparency, and they even use the term unhealthy oligarchy. It sounds like it allowed common property to just disappear.
Pretty much. Illegally transferred is the allegation. And a key part of this, what makes it so tricky, is how funds were apparently mischaracterized to hide the whole thing.
Okay, so our mission today is to piece this all together. We need to look at the specific charges against the management committee, the builder involved, the auditor, even some homeowners.
And crucially, map out the solution proposed in these documents, this homeowner action charter. How can the community actually fight back and, recover what's theirs?
Exactly. So the sources lay out this central problem, this really damaging issue involving a specific payment, 52 lakh, right?
Yes. And how that payment was allegedly recorded was key to covering up the unauthorized sale of common land. If you understand that bit, the rest of the alleged scheme kind of falls into place.
Okay, let's dive straight into that core issue then, the common property scandal. It sounds like it wasn't just an accident. It was a pretty detailed transaction, and a big community asset was involved.
That's right. And it involves this specific piece of land. It started out as 8 individual plots, meant for specific buyers, allowantees.
Okay, individual plots initially.
But those original buyers defaulted. They didn't complete their payments to the builder, so the builder effectively got the land back.
Oh, okay, so the builder has these plots again. What's the next step? This is where it gets complicated, isn't it?
This is the critical legal turn. The builder then reclassified those plots, not as, inventory to sell again, but specifically as common area within the VVR wall development.
Common area, so like parks or roads, belonging to everyone.
Exactly. But here's the kicker. It wasn't a gift. The documents show the cost for those 8 plots, now designated as common land, was then charged to all 78 homeowners. They collectively paid for it.
Wait, all 78 paid for land that was originally meant for just 8 buyers who defaulted.
Correct. So at that point, legally, that land became vested in the association. It was common property paid for by the community.
Which means the builder couldn't just decide to sell it later on their own.
Absolutely not. That's the core legal argument here. Once it's common property, and especially once the association, VVR Way, is formed and takes possession, the builder loses unilateral control. That power is gone.
There are laws about that, right? Like REA.
Precisely.
Yeah.
Our REA, specifically Section 11, 4B, is very clear about restricting a developer's ability to mess with common areas after handover. The control shifts to the association.
Okay, but the sources say that's exactly what happened, like 12 years down the line.
12 years later, yes. The builder went ahead and executed a resale of this community land.
And who bought it? Don't tell me.
The original 8 owners. The ones who defaulted years ago.
You're kidding. So the association owned the land, paid for by everyone, and the builder just sells it back to the defaulters.
That action itself is what the source material calls ultra vires. It means beyond the powers. The builder simply didn't have the legal authority to make that sale. The land belonged to the association, to the homeowners collectively.
Okay, so the sale itself was legally dubious, maybe void, but the pricing, that adds another layer. They sold it at the old rate.
Yes, the historic rate from 12 years prior, the original allotment price.
Wow. So think about property values over 12 years. That's a huge amount of lost value for the community.
Massive. All that market appreciation, potentially crores, just bypassed the community's corpus fund. It was diverted away from the collective wealth of VVRY. It's a direct financial injury.
It clearly benefited the builder and those 8 buyers. But why do it this way? Why not just, pay the debt the sources mentioned the builder owed? This land deal seems risky.
Well, that's where the alleged cover-up comes in.
Yeah.
The analysis suggests that 2 things are directly linked. The builder had this separate obligation, a corpus fund they were supposed to hand over to the association, a cash debt.
Okay, a debt they needed to pay.
Right. But instead of paying cash, the allegation is they used this undervalued community land as a kind of substitute, an offset to clear that corpus fund debt.
So they used land they didn't own to pay a debt they did owe?
That's the allegation. Land belonging to the community was used to settle the builder's private obligation. It's seen as an unlawful substitution.
And it achieved two things for them, presumably.
Seems so. First, cleared the builder's debt without a big cash payment. Second, it allowed this incredibly favorable below-market sale to those specific 8 homeowners.
Okay, but how do you hide that? If the association got something of value, even undervalued land, wouldn't it show up somewhere? That 52 lakh payment comes back into play here, doesn't it?
Exactly. The association did receive 52 lakh connected to all this. But crucially, how it was recorded in the books is key. It wasn't booked as proceeds from land sale or corpus fund received.
What was it booked as?
Refund of project money.
Refund of project money. That sounds bland, innocuous.
Precisely. The critique in the sources argues this specific label was chosen deliberately to conceal the reality that common assets had been alienated, traded away, essentially, to settle that builder obligation.
Okay, help me understand the difference. Why is refund of project money a better hiding place than, say, corpus fund payment?
Well, project money usually relates to the initial construction phase. Funds for building, maybe finishing touches. A refund suggests closing out old project accounts, maybe some leftover funds being returned. Sounds normal, right?
Yeah, sounds like bookkeeping tidying up.
But the corpus fund is different. That's the long-term capital of the society. It's legally protected, meant for future upkeep, major repairs. It's a permanent asset.
So if the 52 lakh had been booked against the corpus fund obligation,
It would immediately raise red flags. Why is the builder settling a cash corpus debt with land? And why is the land valued so low? It forces questions about the underlying transaction.
but labeling it refund of project money just makes it look like old business being settled. It disconnects the cash from the land sale.
Exactly. It obscures the source of the funds, the disposal of a common asset, and makes it much harder for the average homeowner or even a standard auditor to trace what really happened. The permanent asset loss is hidden.
Let's talk about those 8 purchasers now. The ones who got the land back at the old price. The sources are quite tough on them. Did they know? Should they have known this was common property?
That's the million-dollar question, legally speaking. It brings up the concept of constructive knowledge. Maybe they didn't have explicit proof, but should a reasonable person have realized something was wrong?
Getting land at a 12-year-old price probably feels too good to be true.
Right. The analysis calls their gain a textbook pattern of unjust enrichment. They got community assets, paid for by everyone else, at a bargain basement price. Even if they claim ignorance, the massive price difference itself raises serious questions about whether they acted in good faith.
Given how serious this looks, what legal risks do they face according to this action charter? There are 2 main remedies mentioned.
Yes, 2 potentially severe outcomes. The primary one sought is reconveyance, meaning because the builder's sale was ultra vires, beyond their power, a court could declare the whole transaction void from the beginning, invalid.
So the land goes back.
The 8 purchasers would have to legally transfer the land back to the association. They lose the land entirely. They'd likely get their original low payment back, but that's it. No 12 years of appreciation.
That's a huge risk for them. What's the alternative if the court doesn't completely void the sale for some reason?
Then the second option comes into play, restitution. This is based on the idea that nobody should profit from wrongdoing.
Okay.
So the court might say, okay, you can keep the land, but you didn't pay fair value. They would then be ordered to pay the difference, the actual market value at the time they bought it, minus the tiny price they actually paid, plus interest, usually compounded.
So they'd have to cough up potentially millions to make the association whole.
Exactly. To restore the value that was diverted from the community's corpus. It prevents their unjust enrichment.
And finally, looping back to the builder, the sources suggest this isn't just about civil liability, about paying money back. There could be criminal charges.
Yes, that's a very serious point raised. Q20. When you look at the alleged actions, taking property entrusted to the community, selling it without authority, dishonestly diverting the value, and then using misleading accounting to hide it all.
It sounds like more than just breaking a contract.
It really does. The analysis suggests these actions could meet the definition for serious criminal charges under the Indian Penal Code. Things like cheating, criminal breach of trust, maybe even criminal conspiracy involving others.
Wow, that really raises the stakes way beyond just a financial dispute. We're talking potential jail time.
Potentially, yes. It's just the whole dynamic from compensation to punishment.
Okay, so that land deal is the explosive centerpiece. But the sources argue it didn't happen in a vacuum. It needed the management committee, the MC, to either agree or look the other way. So why did they? This section digs into the governance culture.
Right. It seems the MC had developed a culture where accountability was optional. The documents describe an attitude of obstruction, Q1, Q3, when homeowners asked reasonable questions backed by facts.
They were ignored.
Worse, treated as irritants,
Yeah.
like flies buzzing around the heads of the people in charge.
That's not just bad manners. That's a breach of their basic duty, isn't it? They're supposed to work for the homeowners.
It's a fundamental breach of fiduciary duty, the duty of loyalty, the duty of care. By shutting down questions, they're actively preventing oversight. And it forces homeowners to take legal action just to get basic information they're entitled to by law.
Like inspecting records.
Exactly. Section 15 of the Society's Registration Act gives members that right. If the MC treats laws like annoying suggestions, it completely undermines their own legitimacy.
What allows this kind of attitude to take root? The sources mention something structural, this unhealthy oligarchy. What does that mean in practice?
It refers to a specific unwritten rule that apparently dictates who can become president of the association, Q2.
A rule about who can be president.
Yes. The sources state there's an understanding and enforced norm that the presidency is restricted only to members who hold senior military ranks specifically, brigadiers and above.
Wait, really? In a civilian homeowners association, your military rank determines if you can run for president.
That's what the analysis claims, and it's flagged as a major governance failure for a couple of reasons.
I can imagine. First off, is that even legal?
Almost certainly not. It's described as ultra vires, the association's own bylaws, which should allow any eligible member to stand for election, but more fundamentally.
It violates basic fairness, equality.
Exactly. It clashes with the constitutional principle of equality before the law. You can't restrict office based on an external status like rank. It creates a closed loop, an oligarchy, where power stays concentrated within a very small, specific group. Ensures the same kind of people always control the money and decisions.
And this connects back to the land deal. How does this oligarchy enable that kind of alleged misconduct?
Well, if the leadership is entrenched and feels immune from challenge by the broader membership, they might feel emboldened to make decisions that aren't in the community's best interest. Their primary duty is to protect the community's assets.
Like that common land.
Precisely. So when the MC consented to that undervalued land transfer, allowing 12 years of appreciation to just vanish from the community coffers, Q4, Q5.
They failed that primary duty.
Massively. The source commentary is blunt. It calls their consent an act so egregious it raises a strong presumption of collusion or gross breach of loyalty. You simply don't agree to give away millions in community asset value unless something is seriously wrong. Either you're benefiting somehow or you're grossly negligent.
And this lack of accountability is made worse by how the finances are handled. Concentration of power, Q14.
Yes. There's a huge risk identified in who controls the purse strings. Apparently, only 3 people, the president, the secretary, and the treasurer, have the authority to sign off on financial transactions.
Just those 3, for everything. Crores of rupees.
That's the setup described. And what's missing is a crucial check and balance.
Like needing someone else to sign off to, an independent person.
Exactly. A dual signatory requirement involving someone outside that executive clique. Maybe an internal auditor elected by the homeowners, or a designated member of a finance oversight committee. Without that countersignature, there's very little to stop unauthorized money movement if those 3 decide to act together.
It all sounds quite precarious. And then there's this final point in this section, a question about the association's legal standing itself, Q13.
This is potentially a massive problem. The analysis suggests the way VVR is currently structured and operating might actually violate the Society's Registration Act, the very law that governs it.
What would that mean if they're violating the act?
It could jeopardize everything. Their legal authority to manage homeowner funds, to enter contracts, even to file lawsuits or defend against them. If the association's own legal foundation is shaky, any actions it takes could potentially be challenged or invalidated. It's a foundational risk that needs urgent fixing.
Okay, so we have a leadership culture that seems resistant to scrutiny, and now we get to the money itself. How is it managed? This section details the financial complexity, the maze that apparently made it easy to hide things.
Yeah, maze is a good word for it. The scale of the opacity described is pretty staggering. Get this, the association holds over 40 fixed deposits, FDs.
40 for one HOA. Why so many?
That's the question, isn't it? They're spread across 3 different banks, Q9. Now, maybe there's an innocent reason. But 40 FDs is highly unusual. It creates complexity.
And I bet there wasn't a simple list showing all of them.
Exactly. No consolidated investment register, no clear investment policy document saying why they have so many or what the strategy is, no schedule showing when each one matures.
It sounds like chaos or deliberate obfuscation.
The sources lean towards the latter. They explicitly state this fragmented, opaque structure enables things like premature closure or round tripping.
Round tripping, you mentioned that before. How does having 40 FDs help with that? Exactly.
Okay, think about it. If you have just one or two big FDs and you suddenly break one early, it's obvious on the statement, red flag.
Yeah.
But with 40 small ones spread around.
You could quietly close one early?
Right. You close FD number 27 at Bank B, take the cash out, maybe use it for something unauthorized for a short period. Then you quickly reinvest that same amount into a new FD, maybe FD number 41 at Bank C.
So on the surface, it just looks like money moving between investments, like a rollover.
Pretty much. The temporary withdrawal, the actual use of the cash in the middle, gets completely hidden. It obscures the true financial position, hides potential misuse, and makes it impossible for homeowners to see if funds are being pledged or used improperly.
And this lack of basic documentation showed up in the audit process itself. The MC didn't provide key lists, Q11.
Correct. Two critical documents were apparently missing from the audit inputs: the consolidated FD register, that master list of all 40 deposits, and, crucially, the cash flow statement.
Why is the cash flow statement so important?
It's vital for transparency with public funds. It shows exactly where money came from during the year, operations, investments, financing, and exactly where it went. Without it, you can't track the flow. You can't verify the origin of funds, like that 52 lakh, or see how money moved between different pots. It's a basic tool for accountability, and it was missing.
This opacity seems to extend to how income was reported, too. Commingling funds, Q10, Q12.
Yes, big time. Take the interest earned from all those FDs INR 28.65 lakh. It's reported as just one single number.
Okay, what's wrong with that?
The problem is, it doesn't tell you which original fund generated that interest. Was it interest earned on the permanent corpus fund? Or interest from the temporary project fund balance? Or maybe operating reserves?
And why does that matter? Interest is interest, right?
Not when funds are legally earmarked for different purposes. Corpus fund principal, and often its interest, might be restricted for long-term capital needs. Project funds are for specific project completion. Operating funds are for day-to-day expenses.
So if you mix all the interest together,
You can't tell if the MC is, say, using restricted corpus fund interest to pay for routine gardening, which might be improper. It masks whether earmarked funds are being spent correctly. It allows for potential unauthorized commingling mixing money that should be kept separate.
it's like blurring the lines between your savings account, your emergency fund, and your grocery money.
Exactly. A recipe for financial mismanagement, whether intentional or not.
And the sources say they also improperly mixed maintenance fees, the regular income, with capital inflows.
Q12.
Yes, maintenance receipts are operating income, what you use to run the place day to day. Capital inflows are things like one-time deposits, maybe special assessments, or that 52 lakh refund. They should be reported separately.
Separate them.
Because lumping them together artificially inflates the apparent financial health. It can make it look like the regular operations are generating more cash than they really are, potentially hiding an operating deficit. It violates basic accounting principles for nonprofits and societies.
Okay, so unclear FDs, commingled interest, mixed income. What about just moving money between accounts? Was that tracked? Q7, Q8?
Apparently not well at all. The analysis points to multiple unexplained transfers between the project fund account, the corpus fund account, and other asset accounts.
Unexplained meaning. Meaning the accounting entries lack proper justification. There are no references to board resolutions authorizing the transfer, no clear descriptions explaining why the money was moved. It breaks the fundamental audit trail. Every significant internal transfer of public money needs clear authorization and documentation.
And there was a big drop in one fund recently, the project fund.
Yes, in the last reported fiscal year, FY 2024-25. The project fund balance apparently dropped significantly from about INR 45 lakh down to INR 28 lakh. That's a decrease of roughly 17 lakh rupees.
And no explanation for where that 17 lakh went?
The accounts reportedly lacked the necessary supporting schedules or board resolutions to explain it. Was it spent? On what? Was it transferred? To where? Was it written off? Why? This lack of clarity on such a large movement is a major red flag about the overall financial governance and control. If crores can shift between funds without a trace, the system is fundamentally broken.
So, The MC's culture, the financial maze. You would hope the external auditor would catch all this. That's their job, right? But the analysis here of the audit by B.N. Subramania and Co. is, well, it's pretty damning. They call it a formality audit, Q25.
It's perhaps the most critical failure in the chain of accountability, because the auditor is supposed to be the independent check. They're the watchdog for the homeowners.
But they gave a true and fair opinion, despite all these issues.
They did, for FY 2024-25. But the sources argue that opinion was substantively lacking. It basically ignored or failed to highlight all the huge red flags we just discussed, the fiduciary gaps, the unexplained money movements, the missing key documents.
How could they miss so much? Or did they choose to ignore it? Let's look at the specific procedural failures, Q26, Q28. What did they not do?
Well, the most glaring issue is about verification. The auditor apparently relied only on the information the MC gave them. The report even included a disclaimer, something like, no independent verification was done.
No independent verification. Isn't that the whole point of an audit?
Yeah.
To check things independently.
Absolutely. It's a fundamental principle. Auditing standards, like SA 500 internationally, require auditors to get independent evidence. You don't just take management's word for it.
So what should they have done, for example, with those 40 bank FDs?
Standard procedure is direct confirmation. The auditor sends a letter directly to each bank asking, does VVAROR really have this FD? What's the exact balance? Are there any liens or pledges against it? You get the answer straight from the bank, not via the MC.
But they didn't do that.
Apparently not. By skipping independent verification, the audit becomes little more than checking the MC's math. It carries a high risk that the reported balances might not even be real or might be encumbered. It's just not a proper audit.
And they also didn't push for those missing documents, the FD list and the cash flow statement.
Right. By proceeding with the audit and issuing a clean opinion without those crucial documents, the auditor effectively accepted the MC's opacity. Q28. They failed in their professional duty to demand the information needed to do their job properly. It meant the general body never got the full picture.
Okay, let's go back to that crucial 52 lakh payment again, the refund of project money. How did the auditor handle that specific suspicious entry? Q29.
They seem to have just accepted the label refund of project money without digging deeper.
No questions asked. Like, where did this refund actually come from? Can we see the paperwork linking it to a specific project closure?
Apparently not. Crucially, they failed to investigate the obvious connection between this large, oddly labeled cash inflow and the simultaneous, highly questionable sale of the common land. A competent auditor should have seen that potential link and demanded a full explanation and documentation.
So they didn't probe the disguised accounting.
It appears they didn't. Accepting the MC's potentially misleading narrative at face value, without challenge, means the auditor essentially certified a potentially false financial picture. That's a serious lapse.
Did the audit report even check if the association was following basic laws, like the Societies Act itself or RERA rules? Q26.
According to the analysis, no. The audit report didn't confirm compliance with these critical statutory obligations. An auditor's opinion isn't just about the numbers, it's also about whether the entity is operating within its legal framework. Ignoring major compliance issues makes the true and fair opinion pretty meaningless.
This sounds like serious professional negligence. What can the homeowners actually do about the auditor's failure? Is there any recourse?
Yes, there is. This level of failure, ignoring standards like SA 500, failing to investigate red flags, certifying potentially misleading accounts, could constitute professional misconduct under the Chartered Accountants Act, 1949.
So homeowners can complain.
They can file a formal complaint with the Institute of Chartered Accountants of India, ICAI. That can lead to disciplinary action against the firm. Also, importantly, the Societies Act itself, under Section 12D, gives the Registrar of Societies the power to order a statutory re-audit by a different independent auditor.
A complete do-over of the audit by someone else.
Exactly. And that's precisely what the Homeowner Action Charter demands as a first step.
Okay, we've laid out the problems. The land deal, the governance issues, the financial mess, the failed audit. Now let's talk solutions. This action charter sounds like the roadmap for the homeowners to take back control.
It really is the pivot point. Q31. It moves from analyzing the problems to outlining concrete legal steps.
Sure.
The core message is, homeowners cannot wait for transparency. They have to enforce it. Past inaction needs to stop now.
So what's the very first immediate step homeowners need to take according to this charter? Governance action. Action Charter 2.
Requisition a special general body meeting, an SGBM. legally compel the MC to face the members.
How do they do that if the MC is likely to resist? Is there a mechanism?
Yes, the Societies Act, Section 5, provides one. Homeowners need to gather signatures from at least 20%, one-fifth of the total members.
20%, okay. They sign a formal request.
A formal, written requisition demanding an SGBM and stating the proposed agenda, they submit that to the MC.
What if the MC just ignores it, stalls?
The law anticipates that. The MC usually has a set period, often 21 days, to call the meeting, if they fail to do so within that time.
The homeowners can call it themselves.
The requisitionists, the members who sign the request, gain the legal right to convene the SGBM themselves, typically after giving proper notice to all other members. The MC can't legally block it indefinitely.
Smart. And the agenda for this SGBM needs to be specific, right? What key things must be on it?
Absolutely specific and action-oriented. The charter suggests mandatory items. First, appoint an independent forensic auditor, explicitly not the previous firm. Second, formally adopt a new, stringent transparency code for all future operations. Third, establish a permanent homeowner finance oversight subcommittee, the HFOSC. And fourth, pass a resolution authorizing formal complaints to be filed immediately with the Registrar of Societies and RERA regarding the land deal.
Okay, let's focus on that forensic audit. Action Charter 3. This isn't just a standard check, is it?
No, this is a deep dive. The SGBM resolution must define a clear scope. Trace all significant fund transfers for the past, say, 5 years. Verify everything about that 52 lakh entry, where it came from, where it went. It's linked to the land sale. Audit the entire land transaction itself, including getting an independent valuation. And physically verify all those 40-plus FDs, confirm title, balances, any hidden pledges.
Sounds thorough. Does the charter set deadlines or triggers for action based on the findings?
Yes, critically. The forensic report must be delivered to all homeowners within a fixed time frame, like 60 days. And there's an escalation clause. If the audit uncovers financial discrepancies above a certain threshold, the example given is 5 lakh, or if it confirms a breach of trust like the land alienation, then the plan mandates immediate initiation of a criminal complaint under the relevant IPC sections, like 409 for criminal breach of trust by a public servant agent or 420 for cheating. No delays, no negotiation. It forces the issue into the criminal justice system.
Okay, forensic audit, potential criminal complaint. What about getting the land or its value back? The legal action part. Action Charter Section 4. Why multiple paths?
It creates maximum pressure and increases the chances of success. Different forums have different powers and speeds. Don't put all your eggs in one basket.
So path number 1, the Registrar of Societies.
Petition the registrar under Section 10A of the Societies Act. The registrar has specific powers to investigate mismanagement, declare actions like the land transfer ultra-vires and void, and order the recovery of assets. It can be quicker and cheaper than a full civil suit.
And parallel to that,
File a formal civil suit in court. This seeks a definitive judicial ruling, a declaration that the sale is void, and an order for restitution, getting the differential value back under CPC Section 144. Also, file a complaint with RERA, specifically citing Section 11.4b about the illegal disposal of common areas post-handover, and of course pursue the criminal complaint, FIR, to ensure individual accountability.
hit them from all sides, legally speaking.
That's the strategy.
Finally, to stop this ever happening again, structural reform, Action Charter Section on. This goes back to the oligarchy problem.
Exactly. The charter says the community must pass a resolution to explicitly eliminate that discriminatory rank-based eligibility rule for president. Open leadership positions to all eligible members equally. That's fundamental democratic reform.
And deal with the concentration of financial power.
Yes. Mandate rotational leadership terms to prevent anyone getting too entrenched. And crucially, implement that dual signatory rule for all significant financial transactions, say anything over $25,000. One signature from the executive, president, secretary, treasurer, and one from the new independent oversight body.
Tell me more about that oversight body, the Homeowner Finance Oversight Subcommittee, HFOSC. How does that work?
This needs to be a permanent fixture, a small committee, maybe 3 to 5 homeowners, elected directly by the general body. Ideally, members should have some finance or audit background if possible, but the key is independence from the MC.
And what power do they have?
Real power. They must have the right to review all financial statements before the external audit. They report their findings and concerns directly to the general body, not filtered through the MC. And critically, they should have the authority to recommend specific actions, including disciplinary measures or even initiating legal or criminal complaints if necessary. They become the permanent internal watchdog.
Wow. Okay, this has been incredibly detailed. We've traced how this complex land deal, shortchanging the community by years of appreciation, was allegedly hidden through that one mislabeled 52 lakh payment.
And how that was enabled by failures at multiple levels, the management committee breaching trust, the builder's alleged illegal actions, and the auditor providing negligent oversight instead of scrutiny.
The core finding really seems to be that the MC, builder, and auditor all, in different ways, failed in their fundamental duties.
Yes, and the Action Charter effectively takes these 32 critical questions and turns them from points of concern into a concrete legal and procedural plan for reclaiming control. The key takeaway, really, for VVR Agua or any HOA.
Is that the homeowners, the general body, hold the ultimate power?
Exactly. They are the sovereign authority.
Hmm.
The management committee is just a trustee temporarily holding that power. When that trust is broken, the law and the collective will of the members are the tools to restore accountability.
So, reflecting on all this, what's the final thought for you, the listener, especially if you're part of a homeowners association yourself?
It boils down to this. You have fundamental rights, rights enshrined in law, the right to see the books, all the books, the right to vote, and the right to stand for office without facing discriminatory barriers like rank. The right to question finances, to demand answers, to compel meetings, and ultimately, the right to demand that community assets are protected and, if lost, lawfully recovered. Don't assume everything is fine. Ask questions. Demand transparency. Your vigilance is the foundation of healthy self-governance. It's your community, your money.